There's $7 trillion in corporate debt coming due for refinancing in 2026, and the interest rate on that debt has doubled since it was originally borrowed. This isn't a forecast, it's already locked in. Here's how we got here. Between 2020 and 2021, when interest rates were near zero, corporations did what made perfect sense. They borrowed. Billions in cheap loans to fund expansions, cover uncertainty, stockpile cash. Private equity did the same thing, funding buyouts with money that cost almost nothing. The loans were structured on 3 to 5 year terms. Do the math. 2020 plus 5 years equals 2025, 2026, 2027. The biggest cluster hits next year. When those loans mature, they don't disappear, they get refinanced. Same amount borrowed, different interest rate. Except now the rate isn't 2%, it's 6%, sometimes higher. Take a $1 billion loan. Going from 2% to 6% adds $40 million in annual interest expense. Now multiply that across thousands of companies. Some can handle it. They have revenue, reserves, room to cut. But a lot of companies were already marginal, the ones earning just enough to cover their interest payments, but not enough to actually pay down principal. Economists call them zombies. When money was cheap, zombies could survive indefinitely. When rates double, they can't. Here's what else is baked in. China's property sector is still collapsing, not the dramatic version you saw in headlines 2 years ago, the slow version. Developers still defaulting, projects still unfinished, households still refusing to pay mortgages on apartments that don't exist. The Chinese government has tried stimulus, rate cuts, liquidity injections, but the problem is structural. Too much supply, not enough demand. That doesn't resolve in a year. 2026 is when more developer debt matures, more bonds need refinancing, more projects can't be completed because the money isn't there. And when Chinese consumers feel poorer, they spend less, which means global companies that rely on that spending, Apple, Tesla, luxury brands, commodity exporters, earn less. Not catastrophically, just steadily. Then there's commercial real estate. Offices are half empty. Remote work isn't going away. Companies are shrinking their footprints. Property values are falling. And a lot of that real estate is financed by regional banks. Here's the uncomfortable part. Those loans are coming due in 2026. Regional banks are sitting on billions in commercial real estate loans that are underwater. The property is worth less than the loan. As long as the borrower keeps paying, the bank doesn't have to acknowledge the loss. But when the loan matures, there's a choice: refinance, pay it off, or default. Most borrowers can't pay it off. Refinancing means convincing a lender to issue a new loan on a property that's lost value at a higher rate. A lot of lenders won't do that deal, so default becomes rational. When defaults rise, banks take losses. When banks take losses, they stop lending. When they stop lending, credit tightens. When credit tightens, the economy slows. This feedback loop is already beginning. Now add this. The U.S. government is spending over $1 trillion a year just on interest payments, more than defense, more than Medicare. And every time the Treasury refinances old debt, it's doing the same math as everyone else. Bonds issued at 1.5% are being replaced with bonds at 4.5%. The interest burden is compounding. There's no immediate crisis. The U.S. can still borrow. Treasury bonds are still the safest asset on Earth. But the trajectory is unmistakable. Interest payments are consuming budget space that used to go to everything else. At some point, that becomes a political problem, not just an economic one. Here's the irony. A lot of people are optimistic about 2026. The recession everyone predicted for 2023 never came. Inflation cooled. The job market held. AI is driving new investment. Markets are near all-time highs. All of that is true. But debt cycles don't care about sentiment. They're mechanical. Loans mature, rates reset, payments come due. And when enough payments come due at the same time, things that looked stable start to crack.
This isn't a prediction of collapse, it's an observation of pressure. Pressure doesn't always break things. Sometimes systems adjust, companies survive, banks absorb losses, governments manage the math. But not always. The question isn't whether 2026 will be a disaster, it's whether there's enough slack in the system to absorb what's already in motion, because the bills are coming and they're not negotiable.